Hi everyone. Okay, I think most of the participants are here, so we'll just start off. So thank you everyone for joining us today at Mapping the Money, who's got cash to back deep tech in Singapore. We will be sharing an overview of the process for identifying and connecting with an investor. So I would like to welcome Hugh Mason to present today's topic. Hugh, please.
Thanks, Susan. I hope you can all see me and hear me now. I will pitch straight in, hoping that everybody's here. So let's try and pull this one up. Here we go. So what I'm going to try and do today is give an overview of what deep tech is, not from the perspective of people who are practicing deep tech, but from the perspective of the people who might put money into it. I think that's really important. Everyone on this call, there's a lot of people on this call who are involved in doing deep technology face to face, but I think it's really important to see how other people view it. I'm going to give a very brief overview of what financing is like, the different kinds of financing that are available and that might be applicable to deep tech. There's a huge range of people on this call. Some of you will have raised money already. Some of you, it might be a first time that you're thinking about raising money for a business, or even are not have started a business yet. So I need to try and cover that range. And I'm going to do it in a fairly shallow way and try and provide some stepping off points so that anyone can pick up and look in depth later on. I'm going to look at what deep tech looks like from an investor's perspective, what the opportunities and challenges of that are. And finally, the key point of this presentation really is that we need to bridge two cultures. If we're going to get money into deep tech ventures, we need to make a connection between the research community and the community with money and the markets. And that's all about opening a dialogue. Okay, so pitching in, this is part of a series of talks that I'm doing with A-Star Central and also with NUS Enterprise. A couple of weeks ago, we talked about marketing in general. I talked about market strategy, getting to market. This is this presentation, and then next week I'm actually doing a session on open innovation, which is important for many deep tech companies, and we'll come to that later. So this is who I understand on the call today. I believe that the majority of people on the call are researchers, but we've also got quite a few practicing startups. So please do post your questions in the chat, and I'd love to pick up on those at the end. For those of you who don't know me, I started my career as an engineer, became a TV producer, working for the BBC, and set up my first production company, which was making mainly science and technology films for Discovery, National Geographic, and channels like that around the world. I've spent a lifetime in innovation, and I've been an entrepreneur for about 25 years. I came to Singapore in 2009 with my family. We're all permanent residents, and I set up JFDI.Asia, which was the first startup accelerator for Southeast Asia with my colleague Wong Meng Weng, who I'll come to in a moment. In fact, this is one of Meng's strongest legacies. When we were setting up JFDI.Asia, the ecosystem was a lot less developed in Singapore. And one of the things that was hugely helpful that Meng did was to put together a kind of a map of the amounts of money that people would invest on the horizontal scale and the kind of stage of funding where they were active, to give a kind of a sense of the landscape of investors. This is what the picture looked like in 2014. Since then, this is Meng on the left here. Since then, Arnaud Bonzon and Florian Corneau have taken that on, and they've developed the thing into a website called mapofthemoney.com. And you can see the data that we've collected with the team on the right-hand side here, Dr. Anthony Loris, thank you. Also, Asha, Arshil, and Jajen, thank you very much for your contributions towards updating that with deep tech. We're going to be uploading more data to mapofthemoney.com shortly. So what I'm not going to focus on today is the detail of naming individual investors, because to be honest, if you go on many of the tech blogs or anything here in Singapore, you can see many of them promoting what they do very actively, and there is a good indication there on mapofthemoney.com. Instead, I'm trying to give you a broader landscape of where you might seek funding for deep tech. But do check out mapofthemoney.com, it's very good. Okay, so I'm going to whisk through this next section on what is deep tech. And as I said at the beginning, really what I want to do here is to give an impression of what deep technology looks like for people who are not practicing it, because that's the key thing if you're going to make a connection. This phrase, deep tech, comes from this lady, Swati Chakravarti, who was working in Silicon Valley in 2014. She came up with this concept with a bunch of other people who'd been trying to get money into companies at MIT, that there was a special situation around companies founded on a scientific discovery or meaningful, engineering innovation. but companies that weren't just about a business model innovation. They weren't about doing what we already know how to do in a new way. They were about new technology. That was a different kind of category. And there were a couple of things she noticed about it. First of all, many investors passed such companies by. They didn't understand them. They were complex. And secondly, that there was a relatively small number of people involved in funding them. And that's a problem if you're in a deep tech innovator, because of course, what you really want is a series of investors competing for a place in your great idea in order for there to be reasonable valuations and so on. So it's in everyone's interest, I think, for deep tech innovations to be more widely understood. And that's partly what was the motivation behind this whole talk series that we're in today. Many of you, if you follow any of those other talks, will have seen this picture before. It comes from IDEO, the Design Thinking Agency. They've tried to summarize what it takes for any innovation to succeed. You know, these things, it's got to be desired by all the stakeholders involved, and it's got to be viable. It's got to generate value for somebody. Those things are all to do with business model, really, mostly. And I think they're terribly important. They're the kinds of things often that if you come from a technical background, you sort of take for granted. But for example, if I give you a little story, we had a proposition come up to us when I was teaching at NUS a year or so ago about a new binder technology for electrodes in rechargeable batteries. This new technology made it possible for batteries to recharge 4 times faster. And we were working with a team who'd come up with this research to say, well, how would you take that to market? And the more we thought about it, the more we realized the challenge of introducing that technology to market is not so much demonstrating that the battery charges 4 times quicker. You can do that in the lab. The challenge is convincing the production director of a battery company that they should bring this new material into their production line. Because of course, if everything goes wrong and you've pumped out hundreds and hundreds of cells, thousands of cells that day, you suddenly got to recall them. Or 2 years later, if they start causing fires on aircraft, that's a huge problem. So desirability is really important, not just for customers who buy something at the end, but also all the other stakeholders and gatekeepers along the path. They've all got to see some value generated for them as well. But this is where deep tech starts. Deep tech is all about new technologies, new science, which makes new things possible. So I want to analyze that in a little more detail. Many of you will be familiar with this concept of technology readiness level. It comes from the 1980s, I believe, from the US, from NASA and the Department of Defense there. The idea that as a technology moves out of a basic experiment into the lab through to something that you can buy off the shelf, it goes through a series of discernible stages. If I give you the example of a piezoelectric crystal, you might discover some new material in the lab. When you squish it, it generates an electromotive force, and you think, okay, I found a new piezoelectric crystal. Before that can become part of a transducer on a submarine, a nuclear submarine protecting a nation's security, it has to go through a lot of steps of development. And typically that journey might take 10 to 15 years, depending on which industry you're in. Now, Professor Steve Blank at Stanford proposed a parallel way of assessing startup ventures, and he calls it investment readiness. The idea that a company might go through a series of steps when it also discovers the business model that's going to make it sustainable and scalable. Because of course, long-term producing startups is not the objective of any of this. It's about producing successful businesses. So what I've done is I've taken those 2 metrics, investment readiness level from just an idea on the back of a cigarette packet through to something that an investor's ready to put money into. And I've also taken technology readiness level, something that's just been discovered in the lab, through to something that you can buy off the shelf. And I've put them on this matrix, and I've suggested that the technology question is about could it be done? And the investment readiness question is about should it be done from a business perspective? And my suggestion to you is that every technology goes from basically top right to top left on this picture. This is a fax machine in the 1960s. I remember my dad telling me about them. He had one in his office in the 1970s. And I was fascinated by this idea as a child that you could post bits of paper into a machine one end and they kind of pop out somewhere else in the world. What happened in Britain is the postal workers all went on strike in the 1980s, about the same time as Japanese manufacturers started producing these things very cheaply. Unfortunate timing for the postal service, because everybody ended up with a fax machine in their home. Now, of course, we don't use fax machines except in very specialized applications. So most technologies kind of go along a path something like that. I'm going to suggest that deep tech sits somewhere here. It's not basic research, and it's not stuff that you could buy off the shelf. It's around this sort of area. And we'll come back to the challenges that presents later on. I just wanted to illustrate it in one particular domain. If we think of internet and digital businesses, you know, the World Wide Web came about, was it 1992, I think, so Tim Berners-Lee did his thing. And that's what really caused the internet to become majorly adopted. The first internet companies were basic things like email, and there was stuff like infrastructure that still had to be sorted out. We didn't really have cloud computing until sort of the early 2000s. By the time we got to Web 2.0 and social networks and all the rest of it, a different set of companies emerged. The Facebook, of course, became Facebook. And it's interesting to remember that, you know, the iPhone is actually only about 13 years old this year. Things like YouTube came along around about the same time. Platforms was the theme of the internet business for the early 2000s, and it still continues to be to this day. So basically, often bringing together buyers and sellers of something. If you think of a service like Grab, it's got riders on one side and it's got people who want to go places on the other. And the job of a platform is very often about matching people up together. Actually, YouTube is a platform as well, of course. It puts together people who want to broadcast stuff to the world with people who want to watch it. And Airbnb is a place that's got people who've got spaces at home and people who want to travel. Platforms are a huge feature of the economy at the moment. But I think we're moving into a new phase, and this is where deep tech comes in. We're moving into a new phase where now the innovation frontier is all about things which are, you know, difficult in terms of regulation. It's hard to know what something like Bitcoin means in terms of traditional financial regulation. Something like WeChat's interesting politically. It raises all sorts of questions about data privacy outside a context like China. So if you were to move WeChat into another country, there would be all sorts of political challenges around that, including around sovereignty, for example. What would it mean if lots of your transactions were traveling through someone else's nationally owned platform? And then, of course, there's difficult technology. I put up Google Translate there because it's something I enjoy using with my son as he learns Chinese. I'm astounded by Google Translate. I think it's absolutely fantastic. It disappears, it's in the background, and it makes my life easier. So lots of deep technology is the frontier at the moment, but of course it's not an old idea. Picking up on some of these pictures here, some of you might recognize the inventors of the transistor. The interesting story behind this picture is that Shockley, who sat down here, really pissed off the other two when he did that, because actually they were the ones that did the work to invent the transistor that was in that picture. But anyway, that's another story. This is a heart valve, obviously implantable, very difficult technology to get right. Nylon, fabulous artificial fibers. That was a huge business that was invented in the 1940s, 50s, and 60s. Penicillin, of course, antibiotics, again, a deep technology. We take them for granted now. And today, we're very much hoping that things like LAMP come in. For those of you who are involved in medical diagnostics, this is one of the technologies that may speed up testing for COVID-19 in a big way. So deep technology has always been around. And I think one of the interesting observations when you look at a random selection of deep technologies like this is that most of these things didn't come from a startup. In fact, I don't think any of them came from a startup. The transistor took decades of research inside Bell Labs. DuPont and companies associated with it spent decades creating artificial fibers. Penicillin was discovered in the laboratory, but actually making it in quantity turned out to be enormously difficult, and it took the huge resources of biopharma companies to do that. And of course, the amount of money you have to invest in testing a heart valve before you can stick it in real people is probably $50 to $100 million. So deep technology also involves deep pockets. However, it is growing. This is a picture of the kinds of startups that have been evolving here in Singapore over the last few years. The red band shows the number which are deep tech. You can see it's not vast as a sort of subsector at the moment, but it is growing. And it's very important nationally for a number of reasons. Let me illustrate that with Shock Meats. You might be familiar with it, some of you. It's moving towards creating artificial proteins in the form of seafoods. The interesting thing about a company like Shock Meats is it also stimulates the whole ecosystem of other businesses around it. As a result of one of these previous sessions, we ended up talking to the founders of Accelerate. That was an interesting conversation because they're actually creating technologies that companies like Shock Meats need to speed up their production processes. So often when you have a deep technology product, it creates a whole ecosystem around it. And I think you can see that very clearly in places like Penang. I remember the first time I went to Penang, I could see these huge semiconductor fabrication plants, but around them there were all sorts of other businesses. and they've grown up to sort of service the fabrication plants. So what you often get happening in this sort of situation is what the academics call communities of interest forming. You get communities around the semiconductor manufacturing industry, but then there's also a community of precision engineering folk. And these blobs I put on here are what the academics call circles of action, the places where innovation typically happens. And it's often on the borders between two communities of interest where the most interesting stuff comes about. So that's why we're trying to create a deep tech hub in Singapore. And there are success stories in the past. You know, Cord Life is now a public business. This is something that we can do in Singapore. It's something that's employing lots of people. It's creating lots of wealth already. I was personally delighted to see that even though we have all of the challenges of COVID-19, the government hasn't given up on this sector. It would have been easy to, perhaps retrench into things that are considered easier to do, but that hasn't happened. There's an acknowledgement that actually there are challenges with growing the deep tech sector, but it is something that's strategically important. This is a picture of Google searches, the number of times people have looked for deep tech over the period from 2004 to 2018. You can see it was something that people looked at quite early, and it's growing in interest. Okay, so deep tech, that's the perspective. Now let's move on to a very quick overview of investment and finance raising. So for anyone who's raised money, this is going to be a very basic overview. What I'm going to try and do is to go very shallow and very broad rather than deep into anything. If people want to pick up on specific issues, do post them in chat. Let's cover those in the Q&A. And if I can't give you an immediate answer, what I'll do after the session is give you links to papers where you can read that, or books. Okay, so 2 ways of growing a startup business. You can grow it organically. It's sometimes called bootstrapping, pulling yourself up by your own bootstraps. The great thing about funding yourself is that you stay totally in control, but it's incredibly slow if usually growing a business that way. Very few businesses are revenue positive from day one, where you start creating enough money, not just to pay yourself, but also to fuel the future. If you're doing deep technology, it's almost impossible to do this. You've got to pay for expensive bits of equipment, expensive laboratories, all the rest of it to do your thing. So bootstrapping is often not an option for deep tech. Why would you look for money for external finance? Here's some of the reasons, and some of the reasons not to do it, some of the reasons to be wary about doing it. And I'm going to take a view as we go through this. I'm going to be, I don't want to sound negative as I go through this, but I'm going to give you the downside as well as the upside, because I think often when we read popular coverage of investment into startups and so on, it tends to be very up, up, up. There's lots and lots of positivity. But actually, I've mentored something like 500 startups in my life, and I've seen quite a few things go wrong. So I'm going to try and give you the other side as well to give some balance. Okay, so why do people look for money? I've listed some reasons on the left. If you're an existing business that's already up and running, it can be things like working capital or buying new bits of equipment that you want to do. If you're a deep tech company at a very early stage, before product market fit, then clearly you've got to fund research. You've got to explore new markets as well as new technology. I think this is kind of obvious, but I've said it on the right-hand side just in case. I notice here in Singapore that there's a lot of fascination with, fundraising and investors, because they have large amounts of money, other people's money, I should say, most of the time. Lots of people are quite in awe of investors. It's almost as if they're thinking of them like a kind of fairy godmother that's going to go, ka-ching, you have permission to go and innovate, right? I'm going to suggest that it's bad to think of investors like that. The people that really matter to your business, your venture, your innovation, are customers and users. That's what really matters. If you can get customers and users, then the investment will follow. So do think quite hard before you take other people's money into the business, particularly around this issue of alignment. We're going to come back with that. There are many reasons to invest in a business, and the reasons for a financier need to be aligned with yours. This is a great picture from the Asian Venture Philanthropy Network, which we'll come back to later in this presentation. It shows a sort of spectrum of reasons that financiers put money into businesses. On the left-hand side, we've got businesses which are only ever going to be for impact, on social or environmental impact, for example. On the right-hand side, we've got businesses which are purely about making money. So for example, I would say that high frequency trading would be over here on the right hand side. As far as I can see, high frequency trading adds absolutely zero value to the world. It makes a few people very, very rich, and it adds a lot of volatility to the public markets, but I can't see that it adds any social value whatsoever to the world. On the other hand, it's extremely hard to imagine how a charity in Somalia campaigning against female genital mutilation, how could that possibly ever become a business? How could that ever work that way? But between these extremes, there is a spectrum of businesses, a spectrum of enterprises. Some of them you might call social enterprises. And actually, if you put on this spectrum something like cold storage, where would that be? Well, so cold storage has a huge social impact, actually. Without it, none of us can eat. Is it run for profit? Yes, it is. But it does have social impact. So I think it's good to think of not an either or, black or white thing about businesses when you're looking for money. It's worth thinking about what's the investor sitting opposite me trying to achieve, how much financial return, how much of other kinds of return. So I've taken this picture and I've linked it to something that a gentleman called John Kingston showed at the Royal Society of Arts about 10 or 15 years ago in London. He took this idea that some companies and some enterprises are very driven for impact and others very much for finance. And he added an extra dimension. He plotted investors with those which are very hands-on and will be very actively involved in your business, and those that are going to be very hands-off. And I thought this was a very useful picture, so I've reproduced it here. Banks just want to give you cash and they want you to repay as you've agreed on time. They're not interested in taking a risk. Charitable foundations don't have the capacity to get involved in your business. They want to do stuff for impact and they want you to get on with it. In the middle, there are a load of things which are somewhere between those two extremes. So government funds things all the way from pure impact through to things that are pre-revenue and trying to create money over here. The public markets tend to get involved with things that are very much for profit. Crowdfunding, some of it is for stuff that's about social causes and some of it is for things that are very much about making money. Where this matters for deep tech, I think, is particularly in relation to medical technology and stuff like that. Historically, a large amount of research is funded by, for example, the cancer charities. That's a kind of crowdfunding. People have given money for cancer research, and that's what fuels an enormous amount of work in laboratories. Corporations have had different relationships with innovation over the years, but some of them do get involved for non-financial reasons, and some of them are very much emphasizing profit when they do that. Here are some of the things that might be more immediately come to mind as more familiar kinds of investment. Venture capital, of course, we'll come back to that. Business angels, you may have met some of those. There are a few accelerators on the scene here now in Singapore. You may not be familiar with this concept, venture philanthropy, and I'll come back to that later. So, how do companies raise money? For any of you who've raised cash, I apologize. This is a picture you'll be very familiar with, but for anyone who hasn't raised money for a business, it might be new. At the start of a venture, you're discovering not just what technology will work, but also what business model will work. Once you've got that basic idea for a business set up, you need to move towards product market fit. You need to move towards a situation where whatever you're selling actually matches what customers are prepared to buy. This red circle is around what most people think of as being startup financing. It's to do with business angels for the first money, and then typically venture capital for the second tranche of money. And then once you're an established business and you've got cash coming through the door, there are a whole series of other sources of finance that become available to you. Now, this is the kind of picture that you'll see a lot of the time, how startup funding works. And it's presented as if it's the only way that it works. And what I want to suggest to you in this presentation is it isn't the only way. And in fact, there are some real issues with this model of startup financing. So the picture here is that someone has an idea, they get together with some friends, they get some money from friends and family, they perhaps raise a seed round of cash. That in Singapore might be under $1 million, so $500,000 to $1 million. They might go on and raise a Series A round. That might be $1 million to $5 million, depending on which sector you're in. If it's something like life science or pharma, it will be higher. If it's something like software, it might be lower. And then eventually you get to the point when you sell the business on the public markets, and that's when everyone gets rich. Or you sell it to a large company and everyone who put money in earlier on gets a return. So that's the sort of story, and there's an illustration along the bottom there of what sort of percentages people might end up owning and so on. A couple of things about this picture. As I say, number one, I don't think it represents the only option, and I want to show you some others. And the second issue is that I don't like the way they've put percentages at the bottom. There's a sort of, it encourages, when you think in terms of an innovation, and you think in terms of percentages, you start thinking in a very PSU way. You start thinking, here is a pie, and I'm going to be giving away a slice of the pie. And what this picture shows here at the bottom is the pie staying the same size, like it was a pizza. And that's not the case. The only point of bringing an extra person into the business or bringing money into the business is if it makes the pie grow bigger. So I think there's a fundamental problem with visualizing percentages like this, because if you think of giving away a percentage to an investor, you're always going to resent that. If, on the other hand, you think in terms of how much does this person or organization make the pie bigger, then you have a much more healthy basis for a relationship. However, you do need to be aware of the fact that most of the time, that path to financing a business doesn't work. Okay. On the left-hand side, CB Insight tracked roughly 1,000 companies, and it looked at how many of them got through the rounds here. Now, if you are a government official setting policy, the kinds of things you're interested in is very large companies being grown in the ecosystem. You want the so-called unicorns popping out. And the number which make it to that stage is pretty small. You can see it's less than 1 in 100, maybe 1 in 120, something like that, right? 1%. So do all these other companies that don't make it to this stage, are they failures? Because it depends on who you're talking to. As a founder, maybe it wouldn't be a failure if it was a great learning experience. Maybe it wouldn't be a failure if it saved a few lives. Maybe it wouldn't be a failure if you ended up with, I don't know, a couple of $1 million. That might be life-changing for you if you're not born a millionaire. Whereas if you're a venture capitalist and everything about the business model of your company is about making huge returns, then a company dropping out here might be a failure. And this is one of the reasons why there is a fundamental problem. I won't go into it in depth now, but I can provide some links for those who are interested. The vast majority of the venture capital industry actually is run really badly. It returns less than the money that's put into it. Half of all VC funds return less than what was put into them. It's astonishing, isn't it? A discussion for another day as to why that happens. But for example, this is the key figure here, I think, that if you put money into venture capital, on average, it's only 5% that will return more than 3 times your money. It's actually not that great an asset class. That's the dirty secret. However, it's just a tool that's developed over the last 50 years or so, and it is an important part of what we do. It's a key part to what we do. So I don't want to sound like I'm knocking all the hardworking VCs who've backed the business I've been involved with, but we all know that there are some challenges with it. Broadly speaking, here's what a venture capital firm does. It takes money from people who've got money but not time, and who don't have access to great investment opportunities. And as part of their portfolio, it gives them an opportunity to be exposed to higher risk, supposedly higher return investments. So for example, if you were a pension fund, most of the time you're going to put your cash into something quite boring. However, at the moment, if you put it into things like government bonds, traditionally a pretty safe investment, protecting money for your pensioners' future, at the moment, those bonds are going to return almost nothing. So by putting the money into bonds that are returning almost nothing, you're guaranteeing that there is going to be a problem further down the line with paying the pensions. So lots of investors, professional investors managing large amounts of money, want to expose at least part of their portfolio to higher risk. And that's why venture capital offers an opportunity. However, one of the challenges is that it is very rare that a venture capital funded business actually pops with a great return. To give you some statistics for JFDI.Asia, the startup firm we ran, it was an accelerator rather than a VC firm, but we invested in 70 businesses. Of those, about 6 or 7 are what I would say strong companies that will return at least 2 or 3 times to our investors. There are 2 or 3 companies in the portfolio, which one of which has just been sold and returned 100 times to us what we put into it. Right? So what happens in a venture capital early stage portfolio is you get this massive power law sort of curve where a small number of investments return disproportionately large amounts of cash, and the whole economics of venture capital is based on that. Before you get to venture capital, however, often the first money that goes into a business will come from individuals, business angels. And traditionally, this is the kind of way that pitching happens to business angels. Before COVID-19, organizations like BANSI, Business Angels Network Southeast Asia, would hold monthly meetings. Someone comes along and pitches. Lots of people here watch the cabaret and sometimes get their checkbooks out. Business angels are interesting people. I'm very grateful they're there. Many of them I count as friends. They come to investing for all sorts of reasons. Some of them, particularly when it comes to things like medtech, are altruistic. They genuinely believe that, this doctor saved my life, and I would like to have other people have the opportunity to have access to their expertise, so I will fund the startup that they're promoting. Right? That's a very real motivation for some business angels. Other people have done a job, for example, being, say, a dentist or something like that, or a lawyer, where you've made good money over your career. But one of the challenges of those sorts of jobs is that you can't create 10 times the income because you need to do 10 times as many patients. If you're a dentist, there's only so many fillings you can do in a day. And also the job after a while gets quite monotonous. I've talked to a lot of doctors, dentists, and lawyers in their 40s who are making good money, but actually they'd like some excitement in their life. So by investing in a startup team, they can share the journey, they can be part of the future. If you're literally, many business angels will invest as a bunch of friends who all play golf together or all play mahjong together or something like that. And for them, it's about being able to say, oh, you see that company, that shop meets. Oh, yeah, I gave them some money, right? I backed them. I gave them their first money. So a lot of that, and most of the time, business angels are not professionals. There are some professional business angels here in Singapore who just do this for a living. But the ones that you want to try and bring into your company are the ones that add strategic value, the people who can make connections for you, who can open doors in a way that you can't on your own. So how do you find business angels? Well, unfortunately, in Singapore, they tend to hide away. There is the business, as I say, BANSI. You saw the logo there on the previous slide. Do approach them. Other countries around the world are a bit more open about this. They list the deals that have been done by angels. They even list the terms of the deals, how much was invested and by who. And you can have a look at that sort of data on Crunchbase or AngelList if you haven't seen those databases before. It tends to be the case that investors in Asia here are much more circumspect. They don't like to reveal the fact even sometimes that they have invested. And that stops them from pursuing this kind of structure. What's interesting and happening in the last few years is that we're starting to get what they call angel syndicates developing. I'm going to go back a couple of slides. This is the way angel investing, the only way angel investing could happen until maybe 10, 15 years ago. The only way, if you were an investor here interested in new technology, the only way you could go and find startups to invest in was to show up at an event like this, somewhere on a university campus, somewhere on a science park. And that's how you would try and find things to invest in, right? There was a matching problem. How do you match people who need money with people who've got opportunities to invest? Nowadays, because we've got social media, and we've got networks like AngelList, what we're starting to see is sort of star investors who've got many, many people who follow them, follow their tips and everything else, acting as a single point of investment. So someone like Brad Felt over here will say, Brad's based in Boulder, Colorado, he would say, I'm investing in this startup. Does anyone else want to come in with me? And effectively what he'd do would be to run a little micro VC fund just for that one investment. And the interesting thing that creates from an investor's point of view is the opportunity to have transparency on the things you're investing in. Because the problem with a traditional venture capital fund is you stick a load of money into this fund and it's locked up for 10 years. You don't have any say over where it's invested. You don't have any opportunity to add value to it. And it feels very remote as an investor. Now, if you want hands-off investment, that's great. But if you think you could add some value to the business, or you have some friends that would also like to come into on a particular investment, then actually this kind of syndicate style might be much more interesting. Sort of related to that, here in Singapore, a business that's come from Estonia is called Funderbeam. At the moment, it's only open to accredited investors. That's people who have a certain level of wealth and experience. But it's basically a private marketplace. It means that startups can kind of list themselves, a bit like going public. You can put your information about your startup online. And people who are on Funderbeam can invest in it, and they can effectively trade shares in your business at a very early stage. I think this is a very exciting development. There's some challenges around it at the moment around liquidity. There aren't enough transactions happening on the market to make it like the public stock markets. But I think it's a very interesting development. It's related in a way to this concept of crowdfunding. You might not know that crowdfunding, the kind of thing that often happens on places like Kickstarter, actually has a very, very long history. Composer Mozart used to raise money this way to do his music. Nowadays, we have pretty well developed crowdfunding, Indiegogo, Kickstarter. Often they run using what they call a threshold pledge system. So someone putting a project online will say, I need to raise this much money to do my thing. Please, will you all chip in? One of the nice things about it is it creates a community around the innovation. So you'll often get people coming forward who can add value to the proposition beyond just adding money. You'll get people offering help as well, or introductions and things like that. So that can be incredibly helpful. As you can imagine, it works for projects that are easy to understand. I can imagine crowdfunding working well for example, medical products that are addressing, imagine you had a gadget that helps people with elderly parents to turn them over in bed or something like that. That's the kind of thing where on a crowdfunding platform, everyone can understand it and everyone can get that. And if you have an elderly parent, you think, actually, that's useful, I would use that. Right. Most crowdfunding is for reward. That means I put money up towards this thing and I get a discount on the thing when it's made. Or I get one, I'm actually effectively ordering it in advance before it's been built. It's the reward that you get for your money is that. There are crowdfunding systems that are all about donation, and there are other kinds of schemes too. There are a couple of different spins on them here locally. Funded Here is very much aimed at technology businesses. It was set up by some very established tech businesses in Singapore, tech investors and entrepreneurs. Fundmill, I think, is evolving into being more like a private market at the moment, but again, it is a business that's worth looking at. These things, of course, in themselves are also businesses, and they're going to pivot and evolve over time as we explore these new kind of mechanisms. What's interesting to me is that, we are starting to move beyond things like angel investment and VC to have mechanisms like crowdfunding considered seriously. I saw this paper the other day come out about the financing terms, starting to publish what are the sensible funding terms for deep technology companies if you're going to do it through crowdfunding. If you have a deep technology that the public could understand, you can share the benefits of it with the public, then crowdfunding might be a valid way to fund it. There are pros and cons. However, if you are offering shares in your company to the crowd, you're effectively doing an initial public offering, and there are laws against that here in Singapore. Or rather, if you're going to do an initial public offering, you have to do it in a very structured way, which is regulated by the Monetary Authority of Singapore. The reason for that is that initial public offerings have gone wrong so often in the past. This book, Extraordinary Popular Delusions and the Madness of Crowds, was written in 1865, and it catalogues, amongst other things, this investment disaster, the so-called South Sea bubble, which happened in the 18th century. Sir Isaac Newton was taken in. He put some money into a speculative venture. He made some money, and then he thought, oh, my friends are making even more, so I'll stick a load of more cash in, and then he lost big time and ended up broke. If a smart guy like Sir Isaac Newton could do that, then of course it could happen to many other people too. So that's the reason why we limit the ability to which companies can promote themselves at an early stage to the public. A couple of years ago, 3 or 4 years ago, you probably saw that people had found a kind of a way around that. There were a whole load of things called initial coin offerings or token sales. And they skirted the boundaries of what was legal, and some people got prosecuted. And then when Bitcoin kind of died a bit over the last couple of years, they kind of backed off, and now they're coming back again. Interestingly enough, there's some fascinating psychology and economics around token sales. The combination of distributed ledger technology, tokenization, and the economics, the cryptonomics as it's called, the combination of that with deep technology is potentially fascinating. However, it's also very complex and very speculative, and you'll see a lot of sort of white papers written by people with masters and PhDs in economics, putting forward ideas as if they are proven business models, whereas in fact they're extraordinarily speculative. And if you get involved in anything, in my opinion, using distributed ledger technology as a technology for creating trust, for example, is a very valid use of the technology. Be concerned about anyone who offers to raise money for your business through a token sale. Really understand what's being talked about. Now, because the failure rate is so high in early stage investment, that's why we've had, evolving over the last few years, a series of sort of structured processes to try and get technology startups through the growth phase and into product market fit and beyond as quickly and as painlessly and as reliably as possible. This picture comes from MIT's Bill Owlett, and he's plotted 3 lines here: a traditional so-called business incubator, an accelerator, and an accelerator that ended up killing a business. The idea of an accelerator is to either make it or break it. An accelerator aims to demonstrate to everybody involved very quickly, is a business going to fly or is it going to crash? And if it's going to crash, let's make it crash as quickly as possible and then take all the talented people, stop them wasting time, stop them wasting money, and put them onto something else. So that's the concept behind an accelerator. There are now several deep technology accelerators here in Singapore. I've just put up some of them. Entrepreneur First is one that many may have heard of. IoT Tribe, the Grip Experience. There are medical accelerators as well. If you are a first-time founder, I would say this because I ran an accelerator, I think you would get a lot out of an accelerator. Even if you're a second-time founder, it can be incredibly helpful to have the accountability that comes through going through a structured process. I won't go through this in detail other than to say that people sometimes confuse angel investments, incubators, and accelerators. These slides are all available to you afterwards. If anyone wants to go through them, want to ask questions about them, here are some of the differences between those 3 things. There's a new kind of evolution of accelerators called a venture studio, which has come out really in the last sort of 5 years or so. The concepts of a venture studio, instead of taking in startups from the wild, which are already formed as teams, typically a venture studio each year will create 3, 4, 5 new ventures, and the people who own the venture studio will create those ventures. They will then bring in entrepreneurs and team members to run them. They will invest in them, and typically they add value to the business through things like distribution channels. One of the biggest challenges for every new business is not just making the technology work, but getting the technology out to people. If you look at the crowdfunding scene and you look at why so many crowdfunding hardware startups have failed, for example, the reason is because it's relatively easy to make 100 of something on your kitchen table. But if you get an order for 10,000 come in, you absolutely can't do it on your kitchen table. And you suddenly have to get into design for manufacture in a way that you'd never have considered as a startup founder. So in order to be able to scale many kinds of deep technology investments, you need access to distribution channels and resources that are totally different to what a startup team would have. I think this is an interesting business. I don't know that much about it. It's a guy called Clarence that runs it. I've been in touch with Origin a little bit. They have a concept that they've trademarked here called venture co-creation. So I hope they won't mind me using it here. As I can understand it, their concept is to, before they invest money or time into creating a new venture, they'll identify a customer for it first, and then they'll pull together the funding and resources and the talent to do it. They'll take some existing, say, deep tech intellectual property, and they will build a business around that, so that they start the business by knowing they have customers before they begin, which is a good idea if you're spending a lot of money. Now, another thing you'll have seen a lot being publicized here at the moment is this concept of open innovation. I'm going to talk about it more in depth next week, but broadly speaking, it's an idea for a corporation to reach out to a larger community and to innovate with the people around it. There are also corporations that actually run accelerators themselves. I think this one's been relatively recently launched. I don't know anything about it. Huawei Spark, but I saw coverage of it. So the advantage of working with a company like Huawei potentially is that the business could distribute your technology worldwide because it's got so many customers. The disadvantage of working with any corporation are that there are many people inside the corporation who have different agendas from each other and different agendas to you. So if you develop a business which is co-owned by a large corporation from day one, you don't really know whether you're aligned. You don't know in every case whether the intellectual property is going to be looked after in the way that you would want it to be looked after. It may be that there are people inside that corporation who've got their own agenda. And the other issue with a corporate accelerator potentially is that if you have the first money into a business coming from a large corporation, most private sector investors won't want to invest afterwards because they'll feel that the decision making around investment may be slowed down by having a large corporate partner on board. It's okay to have a large corporate coming in, say a corporate venture capital firm coming in later down the line, but to have them in right at the beginning, some people would say is a disadvantage. Other people would say it's an advantage. It's for you to decide. I'm just going to tick these off because I mentioned them on the picture earlier on. Don't approach a bank asking for investment. Right? What they need to do is to have, they're not in the business of doing venturing. They're in the business of, generally speaking, of servicing loans. So don't talk to banks. Government funding is a whole other kettle of fish. There is a range of different mechanisms that government uses to invest. And the important thing when you're approaching government, and I'll come back to this in my last section, is to understand the strategic goal of that government agency you're dealing with. What are they trying to achieve? Because it's likely to be very different from your objective. Venture philanthropy is a fascinating area. It's the idea of moving from charitable grants, which are very hands-off, to applying the same kind of rigor that a venture capitalist would apply to an impact investment. Now, if you're interested in approaching foundations, and I put these up here because for, again, quite a lot of deep tech companies, this can be relevant. If you're dealing, again, with something like medtech or some applications of AI, it may well be that a grant-making trust, a charity fund, has an issue in the community it represents and would be interested in talking to you. It could be that a family office here in Asia has a fund linked to their main businesses and that they've got an innovation issue and you could innovate with them. I mentioned this concept of venture philanthropy. The Asian Venture Philanthropy Network is something well worth looking at. They have a database of several hundred foundations and other investors who are interested in impact investing. I'm going to end up very quickly now so that we can have a conversation at the end, just to give you an investor's perspective on deep tech and say, these are some of the things that SG Innovate has identified very helpfully in a report you can see on the left-hand side. It's identified as things that are different about deep tech. And I've gone through them and I've suggested, well, from an investor's point of view, how would that appear? So having an idea, a deep tech idea, which is a discovery or an engineering innovation, is very exciting. However, it means a lot of people won't understand it. It means that when you come to try and put investment into a business, it's very hard to value it. It means that there's going to be technology and regulatory risks that wouldn't be there if you were dealing with an existing piece of technology. But there are investors who would be happy to take that bet for those reasons. If you're dealing with postgraduates and people who are a team that's fundamentally not business people, but is fundamentally researchers, for example, the advantage to that is you've got very smart people. The disadvantage for anyone who knows about the Dunning-Kruger effect is that it's very easy if you have a PhD to assume that you have the brilliant insight and everyone else is just filling in the gaps around you. And that's absolutely not the case. A business venture needs to be a team. Right. And a key question that investors are going to ask is, if I put money into researchers, are they aligned with me? Do they actually want to build value as well as doing great science? It tends to be the case that deep technology investors are older. They've often taken some time to do a PhD. They might have worked in research themselves beforehand. There are many advantages to that, perhaps some disadvantages too, but generally speaking, I would say it was a positive advantage. In terms of the gestation period, there are no advantages to a business that, as far as I can see, that takes 5 years to gestate. It's a real problem. This is one of the huge issues for any deep technology business. If you're researching stuff and it's going to take 5 years before you know whether it's got through regulation or it's even going to work, that's really challenging. So this is the big challenge for the sector. However, there are specialists who understand. But again, linked to that, the fact that you've got to go through multiple stages of testing and multiple stages of regulatory approval introduces a load of uncertainty and a load of delay that from a traditional investor's point of view is all challenge. You know, if I'm an investor and I'm purely motivated by making money, I can stick my cash into fast food restaurants, or I can stick it into something that I understand that's proven, and I can get a return much quicker. So why would I invest in this deep tech thing? So I think you have to be aware of those kinds of challenges. And if you're going to overcome them, you have to overcome a kind of a gulf of understanding. Now, this is something a lot of people are working on. I've put up a couple of pictures of reports here that you can Google for and download if you're interested. People are starting to explore, well, how do you bridge those gaps? How do you overcome them? I think some very good work being done. A key thing I would say, from having listened to hundreds of deep technology pitches over the last few years, is that it's very easy when you are dealing with the technology at the core of a venture to imagine that the technology is what people want to buy, and it isn't. What people want to buy are the benefits of that technology. There's this old saying that comes from Theodore Levitt. He said, nobody wants to buy a 1/4-inch drill. They want to buy a 1/4-inch hole. Actually, they don't want to buy a 1/4-inch hole. They want to hang up a picture on the wall. Actually, they don't want to hang up a picture on the wall. What they want to do is to brighten up their living room. Right? Once you start unpacking why do people actually buy things, the technology is a means to an end. So deep technology creates new possibilities, but those have to be packaged up into products and services, and then people buy those products and services not for themselves, but they buy them because of the benefits they create. So just bear that in mind. And it's often, if you come from a technology background, particularly if you're at the beginning of a startup process, when the technology issues, the problems of making the technology work tend to dominate, the thing an investor is going to be thinking about is, well, I get that, but further down the line, I need to see that this management team is understanding that the commercial issues are going to dominate. So be aware when you're talking to investors, if you're creating something that involves any commercial or widespread social impact, at the start, if you have a very, very technology heavy team, you will have a lot more credibility if you can show that you can have a meaningful discussion about business as well. If you're dealing with government or you're dealing with impact investors, it's worth thinking in terms of this framework. You know, most things in life aren't just pure technology. They have a political dimension to them, as we're seeing with Facebook at the moment, for example. There's an economic dimension to them. There's a social dimension. There's the technology itself. There's an effect on the planet. And there's a regulatory set of issues. Particularly if you're pitching to a government fund, it's very important that you think about, well, if I was a politician or a government agency, how would I look at this? And you wouldn't look at it just in terms of the technology. You would look at it all of those things. So think when you tell your story about addressing all of those. Now, this is my last picture, I think, from memory. I showed this picture early on of sort of the realm of deep tech, where it lies. This is how it appears to people who are non-technologists. It's how it appears actually even technologists who are not specialists in your area. The fact that what you're putting forward is unfamiliar is scary. And if you want people to finance your business, if you want people to buy your product, you need to show how you're going to de-risk it from their point of view. You've got to do that. It's exciting to you because it's cutting edge and at the frontier. That's scary to other people. Two ways of doing it. The traditional way is to get a load of grants and all the rest of it and prove the technology, and then finally go and prove that actually there is a market out there. Investors are less and less keen on doing that because you can invest millions and millions of dollars, end up with something patented, very exciting, launch it, and nobody cares. If you possibly can, try to investigate the business issues in parallel with the technology issues, and that will get you quicker to funding. I've added some sort of final thoughts in terms of tips that I would often give to deep technology companies who are raising money. I'll let you go through those if you want to download the deck. At this point, I'm going to go back to Q&A and say thank you very much to everybody who made this talk possible. Susan, thanks for setting it up. Anthony, thanks for coming up with the idea. And Bern, thanks for being there in the background and helping me put all this together. So I've got a couple of questions I can see coming up in Q&A. Is that the only 2 questions, Susan? For some reason, my screen, I'm going to turn off screen sharing here. I've got 2 questions.
There's only
now.
2 questions.
Okay. So Lun Cheng, thank you. Chalun, may I know which stage is the hardest stage to raise funding? Right at the beginning. It's very, once you've got some evidence that something's working, it's much easier to raise money. It's extremely hard when you have a fascinating new technology that opens up a whole load of new possibilities, but there is no evidence that it's going to work, be approved by regulators, or that the market wants it. Most VCs, thank you very much to JC. Most VCs seem to have the mantra, go big or go home. Your views on this? Well, that goes back to the point I was making earlier on, which is that because venture capital firms take such a risk, every business they invest in, of course, they believe is going to be a great success. But the statistics show that's not the case. In fact, the rough rule of thumb for most venture capital firms is that 1 in 10 companies will be a huge success. and perhaps 8 of the companies, 7 or 8 will die, and 1 or 2 will be, meh. So if you're going to return a great return to your investors, you've got to have some companies in the portfolio that go big or go home, that absolutely do make huge outsized returns. Otherwise, there's no way that the model works. So it's about risk management. In the last page, number 1 is the most important. I'm not quite sure what that means. Include team members who have complementary skill sets. So I'm not sure whether that's a question or a comment. What I would say there, I had an interesting comment the other day from someone who runs a deep technology accelerator in France. He said to me that he was often bringing in folk with PhDs who got great technologies, and he found that the best sort of commercial partners for them were often engineers, because although the engineers didn't understand necessarily the science, as say life science, they understood something about systems, and they weren't afraid of the maths, and they weren't afraid of the complexity of the ideas. So that was a top tip from him: was if you're looking for a partner who might be a good business partner, someone who's an ex-engineer might be a very good business partner from a commercial point of view. COVID-19 changed the landscape for investment in the region. Yes, it has. I think we're still panning out on that. Some of the underlying fundamentals haven't changed. And I think one of the things I didn't really touch on in the presentation is the fact that, I think investment often is driven by factors other than money. I gave you that pestle analysis because the underlying drivers of the economy in Southeast Asia are things like aging population and the growth of the middle class. A third of Singaporeans are over 50 right now, and that means in 15 years' time, a third of Singaporeans will be over 65. So the kinds of products and services that we're going to buy and the kind of ways that we want them delivered to us are going to be very different. So I'm delighted, for example, that there's a new Center for Productive Longevity just being set up at NUS, because I think that does indicate that we're going to see a change of emphasis towards some of those underlying huge societal changes, and COVID-19 clearly is one. It's a bit hard to read where it's going right now, but perhaps you can say already that there's going to be a lot less travel, for example. Okay, Natasha, are Me Too's attractive to VCs in yet untapped but large geographic markets? Absolutely, yes. Thank you very much, Natasha. If you take a business which has already been de-risked and shown to work somewhere else, and you can clone it and do it in a new market, that's a classic strategy. Companies like, they're not deep tech, but Rocket Internet, for example, built its whole investment thesis out of that. It would take business models typically for e-commerce companies from one market and do them in another. So yes, absolutely, that's a very good idea. And I think one of the interesting things, again, going back to those sort of demographic changes, if you take a country like Philippines, Indonesia, Vietnam, as the middle class gets money in those countries, millions of people, they want very predictable things. Number one, they want a fridge and aircon. Number two, they want to send their kids to university. And number three, they want things like health. So there are huge opportunities to innovate, for example, in the way that we deliver medical services in new ways remotely. And that might involve taking technology that's worked somewhere else and bringing it to a new market. Thank you very much for that. For Ram Hari, how much is the vulnerability of the very idea itself when the pitch is being made at different investment levels? Do you mean vulnerability in terms of it being stolen? Or do you mean the risk involved in the idea? Risk in itself isn't something to be afraid of. I mean, venture investors are used to taking risk. They understand the phrase, nothing ventured, nothing gained. So I think if you can show that the risks are clearly bounded, that you're reducing them, and that there is a structured way to create value despite the risk, then vulnerability in that sense isn't a problem. If your question is about vulnerability in terms of, will the idea get stolen? The important thing there, I think, is to do stuff like protect the intellectual property that you can. And there's lots of help here in Singapore from organizations like IPOS, the Intellectual Property Office of Singapore, to help startups protect their ideas so that you can have open discussions with investors. And the fact that you have protected an idea will be seen very positively by an investor. So if that's what you meant by the question there. Okay, thanks KS, thanks to you. For venture philanthropists, are there any typical KPI or returns measures applied to investments? That's a fascinating question. What I would suggest there is you go and take a look on the Asian Venture Philanthropy Network website and look at some of the papers. They've done a whole load of research on that. And the answer is it's still a very evolving field. If you look at some of the investments made by organizations like the Bill and Melinda Gates Foundation, they put a lot of investment into deep tech, trying to fix things like malaria. So do have a look at some of the reporting that's been done around the way that they've tried to understand risks and returns. Okay, there are many accelerators in the market. This is from Chuan Chen. Accelerator market, what makes an accelerator great for startups? I think that having great mentors is a really key thing. What I would suggest if you're thinking about going to an accelerator is reach out. There's often publicity about which companies have already been through the accelerator. Just find the people, Google their names, companies, find out who runs them, and just approach them on LinkedIn or whatever, and ask them, what was it like being at this accelerator? In terms of, what will make a great accelerator for deep technology, a key thing I think would be access to markets. The hardest, if you've got that long gestation period for a deep technology company, if an accelerator can literally accelerate your introductions to customers, that would be incredibly helpful. So if you pick an accelerator that has demonstrably got access to the people that you need to reach, that would be very helpful. Judith has asked, how important are patents versus know-how to deep techs? They are very important. It's extremely helpful if you can get patents. The only thing I'd say about patents is that you need a whole strategy around them. If you have a pile of patents and then someone starts infringing them, you need to have the legal resources to go and sue people. Because otherwise, and this happened, for example, to James Dyson, his original cyclone idea for vacuum cleaners, I think was stolen by a Japanese company, as I recall. And he had to invest a huge amount of money to basically bet the business in the UK in order to win the lawsuit in Japan to protect his intellectual property. So patents are very important, as are design rights and other kinds of intellectual property protection. Go and check out IPOS for that. But you need a whole strategy around it. Daniel's asked, do deep tech startups which have their roots in universities and public research institutions tend to fare better? I think one of the advantages of a university is that you've got a community of people around you. There's a lot of folk who are generally supportive of creating the future. That's what universities are supposed to be there to both educate the next generation and also to push back the frontiers of knowledge. And that's the traditional role. They're not traditionally just institutions that give out degrees in return for paying money, degrees for fees. That's not the model of university, it's supposed. So the whole point of universities, it's an academy, it's a collection of people, a community. And I think I mentioned earlier on that concept of an ecosystem around startups, terribly important, and universities naturally have a community around them. So if you can leverage that, I think you will benefit. Waikang has asked, how similar or dissimilar would you think is a deep tech startup doing fundraising for venture funding or a deep tech focused fund? Gosh, let me understand that. How similar or dissimilar would you think a deep tech startup doing fundraising for venture funding versus a deep tech focused fund doing fundraising? Oh, so you're asking, how is it, what are the differences between someone raising money for a fund versus someone raising money for a startup? The advantage of raising money for a fund is that you tend to be able to tell the investors that you're able to spread the risk across a series of investment properties. The advantage of it, but on the other hand, you may not be able to tell them exactly what those properties are when you start. Right? The advantage of a deep tech startup doing fundraising is that it's very obvious what you're investing in, but all the risk is focused in that one startup. So there's no sort of portfolio effect. So I think that there are different sort of propositions to investors. One has got very focused risk, and the other one has got diversified risk. And generally speaking, when you look at the performance of venture capital, for example, it's the firms that are diversified that tend to perform best. So I hope that's helpful. Okay, that looks like, is that all the questions? Thank you so much for all of those questions. Susan, is there anything else that you want to say?
Hugh, so actually in the chat box, Grace was asking you about for your comment.
Oh, okay. Forgive me here, I hadn't had a chance to read through this.
So the last part.
Is it the very last part here? And
yeah,
it says,
regarding the COVID.
With COVID, global middle class are facing difficulty in terms of purchasing power. Yes, that's true. That's absolutely true. Are investors looking for a fast return? I think it depends. If you're a deep tech investor, the things that you're looking for, you know that it's going to be an 8 to 10 year journey. I mean, to be honest, when we invested in our companies at JFDI, we started doing that in 2012. And it's only now that we're getting the really big exits starting to happen. It's an 8-year journey, even for non-deep tech. I mean, none of the companies we invested in were deep tech, really. 1 or 2 of them have got some AI in, but it's taken 8 years then. So I think that if you're investing, if you're taking money into deep tech, then actually people will be more interested in the long-term trends, and they will see COVID-19 as being something that is going to have an impact. It's actually created huge opportunities. I mean, lots of companies I know which are providing services at a distance, things like telemedicine, have just exploded. Obviously, Zoom it's not a deep tech company, but it's got some algorithms in it and so on, some codecs which are quite clever. So there are some things which actually benefit from COVID-19. So I think I would say that investors take a long-term view when it comes to deep tech. If you've got someone who's looking for short-term cash, then they shouldn't come anywhere near deep technology, because they're going to be disappointed. If you can find patient people who can be with you on the journey, align with your values, and understand what you're trying to do, then you'll have a good investor relationship.
Okay, I think that's it.
Okay, thank you very much, everyone. Thank you, Susan. Thank you, Anthony. Thank you, Bern. Thanks everybody involved in helping put this together. And it's great. If anyone has any further questions, you've got my email in the slides. So take care and see you next time.
Thank you, Hugh, and thank you everyone for joining us today.